Have you ever wondered what really goes into building a world-class bank, especially one that's trying to do things a bit differently?
It's a great question. Banking often feels, well, quite traditional, numbers driven. But what we're digging into today with IDFC First Bank, it does seem to push those boundaries a little.
Exactly. Welcome everyone to the deep dive. Today we're taking a close look at the Q1 FY26 financial results for IDFC First Bank Ltd.
And just so you know, our sources are the bank's own official investor presentations and press releases. They're dated July 26, 2025.
Our goal here is really to cut through the jargon, the raw numbers, and give you the key insights. What's surprising? What's the strategy?
Yeah, we want you to quickly get a handle on their recent performance and where they might be heading. It's not just about the what, but really the why these results matter for the bank, and frankly, the wider banking scene.
And there are some pretty unique things here. Like, have you heard of a bank aiming for zero-fee banking? Seriously. Or the story behind the CEO?
Right. These are just side notes. They seem quite central to how the bank is positioning itself. So yeah, let's unpack it.
Okay, so let's start with the basics, the transformation. IDFC First Bank wasn't built brick by brick in the traditional sense. It came from a pretty significant merger.
Exactly. December 2018. That's when IDFC Bank, which is more of an infrastructure lender, lots of wholesale loans, merged with Capital First.
Capital First was an NBFC, right, focused on retail, MSMEs.
Precisely. So it was a very deliberate move.
Yeah.
IDFC Bank needed to get into retail, diversify its book, and crucially, get that universal bank license. A big shift.
Huge shift. And they've got this very clear vision statement: building a world-class bank guided by ethics, powered by technology, and to be a force for social good. That's quite ambitious.
It is. And they've backed it up with these 7 core principles, things like ethical banking, digital social good, customer-friendly, ESG. It's all laid out.
What about this ethical banking bit? They mentioned something called the near and dear test.
Yeah, I found that interesting. The idea is basically, would employees recommend the bank's products to their own family and friends? It's meant to ensure the products are genuinely, transparent and fair.
Okay, that's a nice principle, and it connects to the zero-fee banking thing you mentioned.
It does. This is pretty concrete. They've actually eliminated fees on 25 common savings account services.
25? Like what?
Well, things like SMS alerts, IMPS, RTGS, NFT transfers, cash deposits at branches, ATM withdrawals, checkbooks, demand drafts.
Mm.
The list goes on. They claim they're the first and only bank in India doing this.
Wow. Okay, but how does that work? Is that sustainable? Giving away services for free?
That's the million-dollar question, isn't it?
Wait.
It's definitely disruptive.
Yeah.
Look, they might lose out on some immediate fee income, no doubt, but the strategy seems to be about long-term value.
How so?
By removing those annoying fees, they're building serious goodwill, attracting customers, especially maybe younger ones who hate hidden charges, and keeping them loyal. The idea is, once you have a happy, sticky customer base, you can potentially offer them other things like loans or cards down the line. It's a volume and relationship play.
A long game, then. Interesting. And you mentioned the CEO's story, Mr. V. Vaidyanathan.
Right. His journey is, well, quite something. He basically took over a small NBFC, apparently pledged his own shares, even his house, to fund it, turned it into Capital First, focusing on retail, and then led the merger with IDFC Bank.
Pledged his own house. That's real skin in the game. What does that tell you?
It tells you there's a certain entrepreneurial drive, maybe a deeper commitment behind the vision. It's not just a corporate job for him, you sense? That kind of leadership often shapes the culture, makes it more mission-driven, perhaps.
Right. That personal story does add a different dimension. Okay, so that's the foundation. Let's get into the building blocks, deposits, and loans. How are they doing there?
Pretty strong growth, actually.
Yeah.
Total customer deposits up 25.5% year on year. That's roughly 2,57,000 crore rupees as of Q1 FY26.
Okay, and what about the mix? Are they still reliant on wholesale funding?
No, that's the key shift. Retail deposits are the star. They grew 24.5% year on year, reaching over 2,04,000 crore. And get this, retail deposits now make up 80% of their total customer deposits.
80%. Wow. What was it at the merger?
Just 27%. So a massive transformation. It makes their funding base much more stable and, importantly, cheaper. That gives them an edge when pricing loans.
That stability is crucial. And what about CASA, the low-cost current account savings account deposits?
Another impressive jump there. At the time of the merger, the CSA ratio was tiny, like 8.7%. Now, as of June 30, 2025, it's sitting at a strong 48.0%.
48%. How hard is it to achieve that kind of shift, especially with all the competition for deposits?
Oh, it's incredibly hard. It really suggests that their customer-friendly approach, maybe the zero-fee thing, is actually working. They're attracting and holding on to those valuable low-cost funds. That directly helps their margins.
Makes sense. And on the other side of the balance sheet, loans.
Also growing steadily. Loans and advances are up 21% year on year, hitting over 2,53,000 crore rupees. But the big story here is diversification.
Right, they started heavily skewed towards infrastructure, didn't they?
Hugely. Pre-merger, wholesale credit was like 86% of their book. Infrastructure loans alone were 19%. Now, infrastructure is less than 1%. It's a completely different profile.
That's a dramatic change. So what's driving the loan growth now?
It's pretty broad-based, actually. Mortgages, vehicle loans, business banking, MSME loans, even some wholesale lending. Those segments together accounted for about 82% of the year-on-year growth, so much less reliance on any one area.
Good diversification. Any specific business lines standing out?
Yeah, a few milestones. Their credit card business, for example. They've now got 3.8 million cards out there. And they're sticking to those customer-friendly features, lifetime-free cards, points that don't expire.
And that zero interest on ATM cash withdrawals, that still seems wild for a credit card.
It is unusual, definitely. It's likely more about attracting and keeping customers than making direct profit on that specific feature. They probably hope cardholders will use the card for purchases, where they earn fees, and become more engaged with the bank overall. Build that loyalty.
Okay, a loss leader perhaps to gain broader business. What else?
Their private wealth management is doing well. Assets under management grew 34% year on year, crossing the 50,000 crore rupee mark. And they're still the biggest player in FASTag, issuing electronic toll tags, over 19 million of them. Shows their digital reach.
That digital capability seems key. Their mobile app gets top ratings, 4.9 on Google Play, 4.8 on Apple's App Store. Forrester even ranked it #1 in India.
Right. And it's not just ratings. They're showing actual business impact.
Like what? How do we know it's driving efficiency, not just looking good?
Well, look at foreign remittances via the app, up 45% year on year.
Yeah.
UPI payments up 44%. That's real business flowing through digital channels.
Okay, tangible growth. What about efficiency?
That's maybe even more impressive. Over the last year, their overall business grew, 23%?
Right.
But the number of monthly calls to their contact center actually dropped by 24%.
Dropped while business grew.
Exactly. It suggests customers are using self-service more, the app is effective, which lowers operating costs and should improve service. It's a sign of scaling efficiently.
That's a powerful combination. Okay, so strong growth, digital progress, but the crucial piece for any bank is always asset quality. Let's look under the hood there. What are the headline numbers?
As of June 30, 2025, their gross non-performing assets, or GNPA, stood at 1.97%. The net NPA after provisions was 0.55%.
Okay, sub 2% gross, close to 0.5% net. How does that compare?
Generally, those are considered pretty healthy levels in the current environment. And their provision coverage ratio, the buffer against those bad loans, is also decent at 72.3%.
Solid numbers. But you hear concerns sometimes about specific sectors like microfinance. How is IDFC First handling that?
That's a really important point, and they seem very aware of it. They've actively reduced their exposure. The MFI loan book is down almost 37% year on year. It's now only 3.3% of their total loans.
So shrinking it significantly. What about the quality within that smaller MFI book?
It's improving. Collection efficiency went up from 98.1% in the previous quarter to 99.0% in Q1 FY26. And importantly, they've increased the insurance cover, CGFMU, a government credit guarantee on these loans. About 72% of the outstanding MFI portfolio is now covered.
Okay, so actively de-risking that specific segment. Good to know. Now, you mentioned their underwriting earlier, this cash flow-based lending.
Right. Their core philosophy, except for MFI, where collection is physical, is lending based on the borrower's expected cash flows, not just collateral. And they often use debit instructions linked to the borrower's bank account. They describe it as working almost like an escrow.
Sort of locking in the repayment source?
Kind of. And they talk about a 10-step stringent underwriting process. The aim is obviously to ensure they're lending to people or businesses who can actually repay.
Do we see evidence that this is working? That the quality of new loans is genuinely better?
Yes, there are some interesting indicators. One is the first EMI bounce rate for insufficient funds. It's a good measure of how well they assess the borrower initially. That rate has come down significantly from 7.1% back in December 2019 to 4.5% now.
Okay, fewer loans are defaulting right at the start. That's a positive sign. But is it a lasting improvement?
That's where something called vintage analysis comes in. They track loan performance based on when the loan was booked,
Yeah.
and what it shows is quite striking.
How so?
Loans booked after COVID, say, from FY23 onwards, are showing much lower delinquency rates compared to loans booked before COVID, like in FY19. For example, the rate of loans being 30 days overdue after 6 months is down by about 65%.
65% lower. Wow. So that suggests a real structural improvement in underwriting and portfolio quality, not just a temporary blip.
Exactly, it points to stronger processes.
Hmm.
And related to risk, they've also tackled concentration risk in their wholesale book.
Oh.
Exposure to the top 5 industries they lend to. That's down from 41% back in March 2019 to just 20% now. And exposure to their top 20 single borrowers is down from 16% to 5%.
Why is reducing that concentration so important?
It just makes the bank much more resilient. If one industry hits a rough patch or one large client defaults, it doesn't threaten the whole bank. Spreading the risk makes the balance sheet much safer. It's a sign of mature risk management.
Okay, that makes sense. So asset quality looks well managed, risk is being reduced. Let's turn to the bottom line, profitability and capital, the scorecard, if you will.
All right, so net profit after tax for Q1 FY26 was 463 crore rupees. Now that's up a strong 52% compared to the previous quarter.
Good quarter-on-quarter momentum, but how about year-on-year?
That's where it's different. It was actually down 32% compared to Q1 of the previous year.
Down 32% year-on-year. Why the big difference?
The bank points to 2 main factors. The impact of scaling back the microfinance business, which had higher yield, and movements in interest rates.
Okay, can you break that down a bit? How did those things hit the profit?
Sure. Reducing the MFI book, while good for risk, meant less income from that high-yield segment. At the same time, interest rates moved. Remember the repo rate cut? The bank passed on 100 basis points to eligible borrowers quite quickly.
Good for customers, but squeezes margins short-term.
Exactly. Their net interest income, or NII, grew 5.1% year-on-year, reaching about 4,933 crore. But the net interest margin, NI, dips sequentially from 5.95% in Q4 to 5.71% in Q1.
So the cost of funds didn't adjust down as fast as the lending rates.
Pretty much. They note that repricing their term deposits downwards takes time, maybe 9 to 12 months to fully flow through. So they expect NII and potentially margins to improve more towards the second half of the financial year.
Okay, so some short-term pain for maybe long-term gain in customer goodwill. What happens if you exclude the MFI impact?
Good question. Excluding MFI, they say NII growth was actually a healthier 11.8% year-on-year. Shows the underlying core business is still growing reasonably well.
Got it. And what about costs? Are they managing expenses well while growing?
Seems like it. They're showing good operating leverage. In the last quarter, total business grew over 5%, but operating expenses actually decreased by 1.4%. That's efficient.
That's key for profitability. Do they have a target for efficiency?
They do, a pretty ambitious one. They want to get their overall cost-to-income ratio down to around 65% by FY27. It was 73% in Q1, or about 69% if you include trading gains. Getting down to 65% would be a big boost to profits.
Definitely something to watch. Are all parts of the bank making money now?
Not quite uniformly yet, but moving that way. The main lending businesses, retail, rural, MSME, wholesale, are profitable. The newer areas, like building up retail deposits in the credit card business, are still scaling up.
But heading towards profit.
Yes. They specifically mentioned the credit card business hit operational break-even in just 4 years. That's actually quite fast in that industry. Suggests the unit economics are working, and it should become profitable as it grows.
That's promising. Okay, last piece of the scorecard. Capital. How strong is their buffer?
Pretty solid. Their capital adequacy ratio, CAR, is 15.01%. And the core equity, the CET1 ratio, is 12.80% as of June end.
Is that enough?
It's comfortable, meets regulatory requirements with a buffer, but they're strengthening it further. They've announced plans to raise 17,500 crore rupees in new equity capital.
Okay, and what impact will that have?
Once that comes in, they project CR will rise to 17.60% and CET1 to 15.38%. That puts them in a very strong capital position, well equipped for future growth and any unexpected shocks.
And reflected in credit ratings.
Yep. They have AA+ stable ratings for long-term credit from all the major agencies. In CRISIL rates, they're a fixed deposit program at AAA, the highest level.
Okay, strong financials overall, despite some margin pressure. Let's shift gears slightly. Beyond the numbers, they talk a lot about ESG, environmental, social governance.
They do. They've even branded their ESG efforts as First Ensure. And they've made some notable commitments.
Like what?
Well, they're one of the first Indian banks to sign up to PCF. That's the Partnership for Carbon Accounting Financials, basically a way to measure the emissions linked to their lending. And they support the UN Global Compact principles for responsible business.
Signing up is one thing. What are they actually doing? Any concrete examples?
Quite a few, actually. On the environmental side, they financed over 2.4 lakh electric two-wheelers. Socially, they brought in over 47,000 new-to-bank women customers just in Q1. And governance-wise, their board is 80% independent directors, which is quite high and promotes good oversight. Plus, about 31% of their office space is green certified.
Okay, so tangible stuff. EV financing, financial inclusion, board independence. That's more concrete. Are they getting recognized for this?
They are. They're included in the FTSE4Good Emerging ESG Index. And a report by Climate Risk Horizons ranked them second best among 35 Indian banks for being prepared for climate risks.
Second best, that's quite high. And any other awards or recognition?
Yes, quite a few. Forbes and Statista named them one of the world's best banks 2025, and Financial Express named Mr. Vaidyanathan Banker of the Year 2024. So they're definitely getting noticed.
Okay, so wrapping this all up, we've gone through a lot. The merger, the vision, deposits, loans, asset quality, profits, ESG. It's quite a story of transformation.
It really is. You see strong growth, around 20% on the balance sheet. Asset quality looks solid. GNPA, under 2%. Net NPA, well under 1%. They're aiming for high teens return on equity. And underpinning it all is this modern tech platform and a very clear focus on the customer.
And it keeps coming back to that core idea: ethics, technology, social good. Whether it's the near and dear test, the zero-fee banking, managing MFI risk carefully, or the ESG initiatives, they seem serious about building a different kind of bank.
Absolutely. That commitment seems genuine, and it's definitely differentiating them in a crowded market. It's not just about quarterly profits. There seems to be a longer-term vision for how the bank interacts with customers in society.
Which does lead to a broader thought. We've seen IDFC First pushing things like zero-fee banking and ethical tests. It makes you wonder, doesn't it? In this digital age, can banking genuinely be a force for social good? Can it set new standards for how customers are treated, maybe even change our fundamental expectations of what a bank should actually be?
It's a provocative question. Can ethics and customer focus truly drive long-term success, perhaps even more effectively than traditional models? It'll be fascinating to watch how IDFC First and maybe others who follow answer that.